Okay. So in trade, we are looking what is to trade. What is to trade? Okay. Now in trade, we're looking at one thing. You have a side of the supplier, then you have the purchaser, then after you have the customer. If you were to put those first, the one side, you have the supplier, the arrow goes to the purchaser, then to the customer, also called the client. Okay, so the supplier has goods and services. So this supplier, now me, the purchaser, I've got to classify what do I need to trade in. I'm saying we are calling this one a purchaser, because you purchase then sell. You purchase then sell. So the purchaser is the same time the seller, that qualifies the person to be in a trading business. And when you are in trade, it doesn't remove the fact that you can also be in production. You get it? If you have a business which does production of goods, then you'll be producing and keeping in the stores. It's producing from raw materials to finished goods and keeping in the stores if you're not trading. So at the same time, still the purchaser remains. The supplier remains. Could be a supplier of raw materials, and then a supplier of equipment or tools. But only that when we are looking at trade, we tend to overlook or underlook the fact that goods are produced. Then we look at finished goods, either purchased or acquired for trade. We say purchased if you are not the one who has produced this. Then you are acquiring them from the store at a value which the company has set. Then, so that we can go and trade them to the customer. So that means that with one perspective of one who has not produced but is simply going to purchase, there is a supplier selling to you at a unit, at a cost price. So between the supplier and the purchaser, there is ordering. Mainly there are some documents that are exchanged in between there. Which one begins? An inquiry. For example, we have specified that we are going to trade in shoes. Then we identify that these shoes are going to be sold to us by Adam Shoes Company Limited. We have the space where these shoes are going to be, and possibly we shall get the customers for them. So one, we can go on net, we can go anywhere looking for who are the producers of shoes to supply them to us, or who are the sellers of goods, of shoes, because you can also buy from a trader. So who are the sellers of shoes, where we can get the shoes at a least possible price or cost, and be able to trade these shoes to the customer, and the customer finds them at a lowest possible price. And then, so one, when you go there, for us, when you've gone into formal trade, it's also informal trade. informal, you just get, you just make a call, or you go there and make the order by mouth. And even pay. Yeah. But in the formalized setting, the persons, you make an inquiry, you could even send an email or a WhatsApp. Then they send you a list with even some pictures of what is there in the stores, with the specifications of size, color, open, closed, leather, fabric, with the specifications of these shoes. Then there you now look at that list which comes after the inquiry. Others call it a wish list, from which you can mark off what you want. Others go ahead to say no, but what could be on this list may not necessarily be what is physically there. You can go and see, yeah. Or ask them to bring some samples, to you, so that you get ascertained, you confirm what the purchase is to be. Then, after confirming what you from the item list, or others call it a wish list, you send an order. You send an order, which other companies call them local purchase orders. Have you heard of LPOs? Local purchase orders. You make an order saying, this item I need 20 at this price. But maybe before you make the order, you can go beyond. Before you make an order, between the item list and you're making the order, to get informed of the price, you can ask for a quotation. Yeah. So please send me a quotation of these specific items I have selected. Then they'll say the unit cost. They are usually by unit costs per item. Then you can, between there, before you make the order, you can go ahead to negotiate for. But you people, this shoe, I want to buy it at 40,000, not 50. But the other one, At 30, yes, I can bear with that. But this one, let it be 40. So between the quotation, before the order, final order, there is some negotiation when you've received a quotation. But the supplier is like, we can reduce if you make the quantities
to reach a certain amount.
Yeah, let them be 70. But at 10, when you need 10 pieces, my dear, we would wish to sell it to you at 40, but it doesn't make economic sense. But again, if you can pick them by yourself, we are not shipping them to you. There are negotiations in there. And then later on, when you confirm, then you can make a final, an LPO, an order, which you call an order note. So the order note will go to the supplier, and the moment the supplier receives an order note and reconciles your items and sees that they are actually in stock, then there is, and the right quantities are actually there in his or in their stock, and then he can even immediately create an invoice saying that these items are going to cost this much. An invoice is like, I owe you money, pay for this is how much the items are to cost, this is the money you should pay. So there are two ways in real life. For you who is buying, you're not the one who invoices.
It is the person who supplies.
Yes. It's the one who is invoicing you so that you may pay.
Yes.
Now, when they send an invoice and you accept the invoice, they can even supply to you goods before paying. Yes. Because an invoice is a legal tool. Those two things, the order and the invoice, are legally binding. When they send the invoice, they can even put a condition that this invoice is due for payment upon acceptance within 1 day, beyond which it is confirmed that you've accepted to pay, even before the goods are supplied. Then when they send you the invoice, you can pay against the invoice upon the negotiations, or they can choose to supply you goods and pay for what you have received. So it is now upon negotiations. So the supplier can choose to say, we are sending you an invoice, pay 50% before we ship. Yes. Before we supply. Now, the goods that you've received the invoice against the order. Then now, some suppliers can send the invoice. First, can be electronically sent. Yet goods are hard to share, to send electronically, to email some goods.
You cannot.
But we usually get invoices on the email, some on the WhatsApp. Then we have received the invoices is 13 million, and then that's the money we are going to pay. But when are the goods going to be delivered? That's now the purchaser's concern. Sometimes upon agreement, the invoice can be inclusive of the freight cost, what we call the cost of freight. You know freight. Freight, you can type it there as FLEI.
FL
Yes.
E
FLEIGHT. Freight. The other word is used is shipping. Shipping costs. Shipping double P. Okay, you don't have your phone right now, but shipping cost is a cost, or we use that word to mean carry. Others call it courier. You've heard of courier. Lift the goods either by vehicle, by car, or by ship, or by air to the customer, who we are now calling the purchaser. The supplier calls him the customer. So, and then they have lifted these goods, and then they are now being brought to you. The cost of moving the goods, this is what we are calling freight costs or shipping costs. Those are goods in transit. Usually, if we agree with the supplier that ship for me, so that when I am paying the invoice, I am paying for the cost of the items together with the cost of freight. Other words, they invoice you on the items, they help you to get who is shipping, and then they ask that the shipping company, or if it is a DHL or Grover, and then they can also use, which other one is it? FedEx. Or it could even be a bus from Kampala to Kapchorwa or Soyoti. Yes, then they say, for us we are invoicing you for only our items. The invoice for shipping, you will pay that for the bus. I think the bus people have said it is 20,000 to transport those goods. So pay the bus people without having included the shipping cost on the what? On the invoice. So others, which app companies are very formal, the shipping company can also raise its invoice to you. You see? Now you have an invoice for. There's a time we were using air, and there were clearing agents who would receive goods from the US to Entebbe. They pay for them, create an invoice including what they have paid for shipping by air, by the Airbus. Then they add their money for working on clearing, and then clearing on the port, on the airport, even URA charges, was when goods are, we shall see under international trade, when goods are cutting crossing borders, you can see that there's that formality of clearing goods across borders. So then for them, they would handle, the clearing agents would again drive these goods to our shop. Then at paying, you pay the supplier the invoice for the goods without freight. Then after, you pay for freight and clearing.
Because the supplier had already added the cost for the freight and also their for the clearing.
The supplier can add.
Oh, he did not.
He did not.
That's why you were able to clear.
Yeah.
On his behalf.
Yeah. He did not. But that is now, it depends on how the supplier has positioned himself. Some suppliers position themselves that they want to be in charge and responsible for the items up to your hands. So they work with the shipping companies, and they know that if you are having this weight, the weight of goods and this volume, how much are you going to transport them? Then they inquire. Then the shipping company will tell them, no, those goods we shall deliver them at 1 million. They can negotiate between there where you are not, and then resolve. Then they add that to their invoice, and then they keep monitoring those goods with that shipping company until when they reach your shop, as they call that dock, until they reach your shop. So for those who position themselves that items, the invoice of the item also incorporates the shipping cost or the cost of freight, they charge you at once, and it is them to work upon everything up to your shop. You only pay one invoice, which is usually a better one. It's a better one, because most formal institutions, you don't over negotiate. They set their costs, you either accept. If you don't accept, you leave them. Yeah. So it's better that one person handles. Then now they are brought. Upon delivery, if one was to manage a physical document, these goods can come with usually they can be sealed. For very highly sensitive goods, they come when they have a seal, and the seal has a code. They send you the code to only you, so that when you enter this code, they unlocks the items. Like you've seen fuel, this petroleum, those tanks have seals. Otherwise, the driver would reach at a certain place and say, let me sell some 40 liters. Put in my pockets.
You cannot open the tank.
They put security seals. And actually they can even monitor the movement of the vehicle. And they ask, why is this vehicle staged here for 40 minutes? They can even call you and say, what are you doing in that place?
They know you want to do something bad.
They monitor electronically. They are those devices. So is to secure products under transit. But now the goods are being delivered to your shop. If they are delivered in physical terms with even the supplier there, because they are two-way, the supplier can choose to drive them to you. You can choose to pick them by yourself from the supplier, or the supplier can choose also to use an agent, a shipping agent, to take for me these goods to the what? To my customer. But all through the invoice is there, but also the delivery, yes, the delivery note. But the moment you sign that I have received these goods and they are in good what? Condition and order, then you have received, you have acknowledged having received them. If they get broken at your shop, yes, you told us that you received them in a good state. Then how comes they are damaged? You're saying they are damaged, or they are inadequate in number, or they are wrong specifications. Tell us. So, but that's why usually the purchaser, who is now the customer of that supplier, can choose to say, okay, before I sign on the delivery note, let me have the invoice. You reconcile the invoice against your order and see, is the invoice given to me tallying with the order that I made, or they are invoicing me for more yet I ordered for less, or even the value, the prices, they are charging me more than what I had actually ordered at. If they are matching, that's one thing. If they are not matching, then there are red flags on such items. Then the other one is tally the invoice against the delivery note. You see that order? Now this is the invoice which you could be either agreeing to, and then there is also delivery note. Then you are now tallying. The invoice is saying 7 items at 50,000 each. What of the delivery? Are they 7?
7 times the same price.
Okay, that is okay. If that is okay, are they the same specification? I wanted red. Are they red? The order informs you the color specification, the size, then the number. But is it really functioning? Because there are some gadgets, could be gadgets, are they really functioning? But that functionality is another. Because some of these gadgets, those that are working in gadgets, to confirm functionality, then they allow you a guarantee, so that you don't need to unwrap goods, yet the customer will need to find them when they are sealed. So they allow you some guarantee. So that guarantee, even the customer shares on the same guarantee, just in case there are issues. Most suppliers are open to receiving those items back and working upon them. So when you reconcile the delivery note against the order note, and then you find that what has been delivered is either wrong, those ones you separate them. And then you find that those which are delivered and they are in good state, those ones you tick them off and they are in right numbers. Because there is also undersupplying, there's also oversupplying. You ordered for 5 but they have supplied 7. That's over. And then you ordered for 5 but they have supplied 3. That's under. So for under supply, you don't return. You may not return, but you may seek for additional goods. But oversupply, you may either, if you don't want to return them, you can choose to accommodate them and pay for that extra cost. Otherwise, you can return them if you don't want. But with the negotiations with your supplier, because there is also that good rapport, a good environment you create, a friendly environment.
With your supplier.
Yes, with your supplier. Now I wanted 5, but now you've given me 7. What do we do? Say, for me, he says, I'm going to create for you an extra invoice for those 2, but first sell them. When will you pay? Within 4 months, within 3, I will pay them. Yes, because the cost of shipping back goods, especially if the distance is longer, is very high. So it becomes very costly to you, but also it is a burden to the supplier. So now you have reconciled the delivery note versus the order note. That's not enough. You've got now to have now the confirmed delivery note. Then you go to reconcile delivery note versus physical items. Yes, it is on the delivery note. They are 7. Yeah. Are they also 7? You keep doing that for each and every item until you append the signature on the delivery note confirming that the goods supplied are okay and they have been accepted. So however, when the goods are supplied but are not in good order, okay, they are not appropriate. Either they are wrong specifications, wrong size, wrong color, and the wrong quality models, then you better communicate in writing to the supplier and then agree that these goods can be, remember that they are should always be balancing with the invoice and also balancing with the delivery note. So from there you can now see that if goods are wrongly supplied, either with wrong specifications, color, size, functionality, or models, then what you can do is to make sure that you create a credit note. You credit them. A credit note is a reduction on the invoice. It's like saying, let me reduce this invoice by 5 items.
That one becomes a credit note.
Yes, a credit note. What they usually call a goods return note, a return outward note. Return out to the what? To the supplier. So if you've returned them to the supplier, then the invoice should be reduced. So that is a credit note, or a good return outward. But if the goods are overstated, they are much more than what was invoiced, then you need to have an extra invoice, which we call a debit note.
That one is simply add.
Yeah. Yes. So you add more on the invoice. Because what is happening in business is that these days, when you receive an invoice from the supplier, usually this invoice is entered in books of transactions. Those years there were purchases journal, purchases day books. But these days, books of accounts are becoming electronic. That you others have QuickBooks point of sale. You've seen on the supermarkets that you have when you receive goods and say, I've received sugar 25 kilograms. You enter them into the software directly, and you debit stock increases by 25 kilograms. That as you enter to sell sugar to a customer 2 kilograms, you'll be reducing on the 25. You can even see that I've made, by clicking yes, make a sale, a receipt is produced, but at the same time the kilograms are reducing from 25 to 23. You can even monitor what is in stock using software, which in very many years back you would monitor, but you needed to do more of add, subtract, manually.
That was manual.
Yeah. But here it's somehow automated. And at the same time, they also have some software for accounting, for mainly the sale, trade, point of sale. There's software called point of sale. You enter in stock, then when you sell, it also reduces stock, increases cash. So those are good for trade. But the other side of finance, where you need to run an income statement, that's how much sales, what were the cost of goods sold, and gross profit, then expenses, gross profit less expenses, we have what? Net profit, or either a net loss. All that things are happening at the same time. As you make this transaction, the reports are being created. I thought that is your movie. So in this session, I intended to first look at the story where we said that we have three players here: the supplier, the purchaser, the customer. Though we have not yet reached out to the customer, we can see that supplier has items. The supplier can choose to have a shipping service or to work with shipping agents, those who can transport goods, or the purchaser can also have his own shipping service. So the issue is, let us have goods supplied in the least possible time, what we call what you can call the lead time. The lead time is the time goods take from the time of ordering to the time of delivery. Yeah. So that time should be swift but not damaging goods, and at the same time no delay. The best supplier will make sure they are supplied at the least possible time, at the most affordable cost, and the right quantity, the right quality. And that one is the one would call the best supplier. And then the supplier can keep on informing the purchaser that this is how far your goods are. There's a shipping company we used to use. This was DHL. DHL has that system. You order and they ship with DHL. DHL keeps informing you the goods are now in New Delhi. They have reached South Africa. They are now near the plane is landing in Kenya. By reporting, you can see a trail, and then when it has now reached Entebbe, you can see that the goods are near to reach you. Upon delivery, they tick off. And I think even here Jumia is using it. Jumia is using it as well. So that in trade there is feedback. People are already, their hearts are like, when will they bring? You have nothing to promise a customer who is waiting for their goods. So they may come yet tomorrow. I think within 2 days, but maybe if they delay 7 days, no, that kind of.
It keeps you wanting.
Here they are putting you in a position of assurance that within 2 days they will have reached, and actually they reach. So that kind of in trade, if you are or you are teaching students, or otherwise you are doing trade yourself, to make sure that goods are available in stock on the side of the supplier. They are available by making sure you manage how you manage what they call minimum stock levels. When minimum stock level is, now I'm trading in shoes, I expect that every day I'm selling 2 pairs, but it takes me 3 days to order and receive goods. It means that I should order when I have at least 8 pairs of shoes.
That is your balance.
Yes, in the business. So that by the time they deliver, maybe I have some 2 pairs. That's minimum stock level 8. So beyond which, if you drop below that minimum stock level, you are in a critical zone. It is critical. Otherwise, if you don't order beyond the critical level, you are going out of stock.
Because by the time you order, this stock would have gotten finished.
Yes. So the supplier and still the purchaser, who is the trader, they are in charge of stock handling. Stock handling versus supplier handling versus customer management. Then the other aspect that comes along is season. I heard my colleague was crying in Chikubo. This month of January, February, and March, these are very hot months in business. But other businesses are actually enjoying like a season. Yeah, and are doing well. So it is only that the products he's selling may not be needed in the season. So the person is dealing in clothes. It would mean that this person centralizes on even materials of uniform materials. Because now children are going back to school. Besides having bed materials, bed sheets, blankets, and all that. Though some can buy for students going to school, but these are one-time, 1 week purchases. So it is a balance, but most especially is to manage stock, not to overstock, that the capital will be staying in stock you're not going to sell. Just capital held. So the balance is now there. Which one can I stock more than the other, and why, and in which season? Then the other aspect is triggering on the customers to make sure that they are more to buy more. But eliminating excess stocking is what we call a shelf life. Even students in the universities, the university has a shelf life for the student. A bachelor's is 3 years.
What does it mean?
So if the student studies for 5 years, that one, the shelf life has gone beyond the shelf life.
Period.
You stock shoes, and 1 year the shoe is there, 2 years the shoe is there. That shoe is consuming rental space if you are renting, and is using that space longer. Yet if you were able to sell it, and then you sold 20 pairs in that very space, you sell this, you replace another. So 20 pairs have consumed the same rental space than a single shoe, a single pair of shoes. Then we say the cost of this shoe being in the shop is very high. We rather sell it at a loss, but eliminate it. Other than having them congesting the whole room and they are not being sold. That is shelf life. One should have minimum shelf time, which we call life. Shelf life is shelf time for stock. When we open, how do they call them? These things they cut in the city to remove clothes and a container. When we open a container, to sell a whole container should last a month. That is the minimum shelf life for that batch. If it stays for 2 months, we have made losses. So that counts for that counts for making sure that you're selling more to reduce on the shelf life of your goods. The more they stay, the more they cost you, and the more you're not making financial or economic sense. So with the shortest shelf life, short shelf life also means high turnover. You get it?
Because we are making profits almost.
High stock turnover. When I buy a carton and sell it all, that is 1 turnover. 1 turn. You get another carton, sell it off. Sell another one off. Within a month, if you sold that 50 cartons, those are 50 tons of turnovers. So it means that if you sold 50 and the other one has sold 30, you have more turnover than the other. So you are making more profits than the other. And you who has high turnover also means that you have short shelf life for a carton. It comes, you bring in the cotton, stay a short period of time, you order for another. So that is a better business environment than the other, where you're having more shelf time and less stock turnovers. You keep waiting in the room, waiting for customers, and then you become like a security person to the stock. Yeah. So that is it. So we shall add on that little story of the rapport and the linkage between the supplier and the purchaser. But most especially, we have seen that the purchaser has a need which he has to specify that these are the particular products I'm dealing in. And then where are the suppliers of these products? You can choose to have several suppliers sending to you the wish lists or item lists where you are making inquiries, so that you don't conclude by looking at two suppliers and say this is the actual cost of this.
Yeah, what if they don't have at a certain point?
Yeah. Sure. So you need to have more of them, then compare their wish list, the quality of their products and the quantities they could be having, all the specifications that you need, and then choose from them to have you the item list. Then you can ask them to get you a quotation. Then from those who have quoted, you can choose to order from one of them or two of them. Then after ordering, they invoice, then they supply, then after supply they have an invoice, a delivery note. After looking at the delivery note, then you can confirm. We call it a reconciliation. And you can reconcile. After reconciliation and everything is okay, then pay the supplier for the goods supplied. You can choose to pay by electronic means or through the bank. These days there is what they call till number. I don't know whether you've heard. A till. T-I-double-L. A till is the drawer. Is a till, that drawer where they lock money.
That is cash.
But it is cash. That word is used. A till number is used to still mean you're paying it to a particular account in that business. Like a mobile money. Even mobile money, they tell you till number this. But that money does not go to MTN or Airtel, but goes to
a particular account
of the supplier.
Yes.
That is a till. So others have actually opened up till numbers, and you can pay using a till code. That code they give you.
Yes.
That is the last stage. You can make a payment. Then after you own the goods, now there you have to start on. Yeah. Okay, we shall add on more when we get together, unless there is a question.
You said on Friday we shall be having production.
Yes.